at the Oxford Internet Institute and excited to be one of the student facilitators for this conference. Today, I'm excited to introduce Professor Ross Buckley of the University of New South Wales. We're super excited to have Professor Buckley today to be discussing the international implications of central bank digital currencies. Professor Buckley, you have the floor.
Thank you. Thank you very much. You can hear me okay? So, central bank digital currency, the international implications. Digital currency, I think we're all familiar with. We all need it in a developed economy to live, right? We get paid in digital currency, we pay bills in digital currency, we shop online in digital currency. Frankly, I think without digital currency, with only cash, it would be very difficult to participate fully in economic life in a modern advanced economy. So there's nothing new about digital currency. What is new is that we're now talking about central bank digital currency, because the digital currency you and I use every day in our life is not issued by a central bank, it's issued by commercial banks. It is simply promises of a commercial bank, and therefore there is settlement risk in it. In other words, if the commercial bank fails, the currency may not be worth anything. The only central bank money that individuals have in modern economies is cash, and the usage of cash is declining precipitously. Less so where you are than where I am, but in Australia, very few people under, say, 35 years of age carry cash. It's almost unheard of, and increasingly, most people do not carry cash. In Sweden, 70% of bank branches don't carry cash. Cash is in precipitate decline in Sweden. So as cash goes into decline, the central bank comes out of the business of minting the currency that the average person uses. And that really concerns some central banks in terms of inclusivity and other reasons. But it's also a strange thing, because I don't think most people realize that. Most people think the money they use is the product of their government. And while the government gives the money its name and influences its value, it doesn't create what most of us use. Unless, that is, governments start to issue central bank digital currency to address the decline in cash usage. And over 90 central banks, well over 90 central banks, are running pilots or advanced research programs on this. But it's a difficult topic to discuss, because while a lot of research is going on, there are no major economies yet with a central bank digital currency in place. Nigeria has one, China has one, but apart from that, in every other place of any significance, central bank digital currency is an idea that's being researched, it's being piloted, it's not actually something that's happening. And it's a difficult idea to talk about for this reason, and the international discussions about it are marked by confusion and get rather heated, and are not marked by a whole lot of understanding. And there's a few reasons for this. Partly, I think it is that money is cultural. So when people talk about money, they're talking about it from the perspective of their own culture. Culturally, money means something different to Americans, I think, than it means to Europeans or to Australians. Also, you can build these things in lots of different ways. A central bank digital currency is simply a digital currency issued by a central bank rather than a commercial bank. But it can be token-based or it can be account-based. If it's account-based, the ledger is maintained by the central bank, so it's rather like citizens having an account with their central bank, which up until now they've never been able to. But if it's account-based, you need internet connectivity all the time for it to work, and which means you need regular electricity supplies. So in a lot of developing countries, they're looking at token-based systems, where the tokens can live on a phone when the internet connectivity is not there, the electricity is not there. Once the connectivity is restored, the transactions can be reconciled. But in the meantime, payments are made by a token going from one person's phone to another person's phone. So there are different ways to build it, and there are different ways to structure it. It can be direct or it can be hybrid. In other words, citizens could have their central bank digital currency relationship directly with their central bank, or they could have it with their commercial bank the way they do now, except the commercial bank would be dealing with obligations of the central bank. They would be on a central bank ledger, not on a commercial bank ledger the way they are now. Whichever way you structure it, it can cause stability concerns, because if in a highly risky situation when markets are unstable, citizens' money can run into central banks. If people are well advised, that's where it should run into. You should have the mother of all bank runs. If you get a repeat of 2008 or 2011-12 in Europe with CBDC, you should expect major bank runs, and therefore lots of limits are being put on this. Lots of limits, particularly in the EU. You'll see there's a limit of €3,000 or €4,000 on how much people can hold in a digital euro account. So there's these very different perspectives around the world. They're partly driven by the different ways you can build it and what you see as the purpose of it. In the US, they're very skeptical about, they're doing a lot of work on a digital US dollar, but they're rather skeptical about it. The EU is rather more keen. And I think part of that is that if cash declines in the EU is largely left for its payment infrastructure with MasterCard and Visa. That's more attractive to the Americans, given MasterCard and Visa are American entities, than it is if they are, that it is for the Europeans. But the other thing I would say is both the EU and the US are looking in the wrong place. And that's the real reason this debate is not going where it needs to go, I think. Because they're both looking at home, and the digital euro is a project at the moment designed to build a euro that would be used for payments within Europe. But payments within Europe work very well. Payments in the US work less well. The US banking system is 20 years behind anywhere else. But even then, payments within the US work much better than payments do internationally. And it's in international trade in particular that the real potential for a digital central bank digital currency lies. But for some reason, in most of the world isn't looking at that. Australia is, Singapore is, in my part of the world, both the Central Bank of Australia, the Reserve Bank of Australia, and the Monetary Authority of Singapore both believe the potential of these instruments lies in solving the big problems we have in international payments. But for some reason, that view doesn't seem to be being replicated in the US and the EU. So if you're living in a well-functioning, developed economy with a good financial system, which I would say the US is on the margin of, but most other developed economies have marvelous payment systems. You don't really need a central bank digital currency for retail payments. You may wish to have it because the central bank may not want to be out of the business. And if you read the reports issued by the Central Bank of Sweden, they note that the Swedish central bank has been issuing the means of exchange in that part of the world for something like 500 years. And it's clear from the language of the report, they're deeply uncomfortable with the idea of the central bank not being in the business of minting means of exchange. And as I said, Sweden leads the world in the decline of cash. And the Swedish central bank explicitly states it doesn't trust commercial enterprises to deal with remote Laplanders living in the north of the country or elderly people or otherwise excluded people. So they think pretty clearly the government needs to be in the business of issuing the actual means of exchange. So they're interested in a retail central bank digital currency. But you'll hear a lot that CBDC is a solution in search of a problem. That is largely true if you're looking at the payment systems in rich developed countries domestically. Those work well, so they don't really need a CBDC. But if you look at the international system, it's hugely inefficient. The finance minister of Brazil quipped a year or two ago that the quickest way to move money from from Brazil to London was to get on a plane in Sao Paulo with a suitcase of the stuff and fly it to London. And he was partly being humorous, but that's also true. It takes whatever it takes to fly Sao Paulo to London, 12 hours or something. And it certainly takes longer than that to move money around. And it often costs 1 or 2%, depending on the currency pair involved, because there's correspondent banking relationships. One bank sends money to its correspondent bank in another jurisdiction that then might send it to a third bank that then sends it to the fourth bank, which is the bank of the recipient. And each bank takes fees. There's no obligation on the banks to route these funds in the quickest or cheapest way. They tend to route the funds through what we've described in one of our papers as best friends route rather than most efficient route. So it's a very expensive, slow process to send money overseas. And central bank digital currencies should be able to do that for 2 or 3% of the cost at the moment and in seconds. And there's a lot of work being done between groups of central banks around the world, and Australia is participating in quite a few of these. Lots of projects to work out how central banks can establish accounts with each other, and the transfers can be through CBDC from central bank to central bank in seconds, not through a series of commercial banks with the delays, with the attendant risks, with the attendant costs. So if you're looking for somewhere where the big gains are on offer, it's in international payments. International payments are slow, they're expensive, and CBDC is a solution for this. And the costs on international payments at the moment really function like a tax on international trade. And nobody benefits from a tax on international. Absolutely nobody. So it's sort of amusing to me that there's these heated arguments, and I'm involved with international panels on this stuff quite often, heated arguments between the Europeans and the Americans and other countries on why we need this, what it would do, those sorts of things. But it seems to me everybody's looking at home, and they should be looking at the international relations, not at their domestic systems. I'm not sure why it's probably more obvious why somewhere like Singapore is looking very distinctly internationally, because it's a very outward looking interconnected economy. But the big economies, the US and the EU, are not doing that. So what are the international, one other thing I should say, the other big weakness in the current system is, in addition to expensive, slow international payments, is remittances. So remittances of money by expatriate workers, Filipino maids in Saudi Arabia, Tongan and Samoan people working in Australia and New Zealand. The cost of those remittances are egregious, appalling. The remittance corridor between my country and the Pacific Islands, it often costs 7 or 8% to send money. So somebody who's earned $500 picking vegetables under the hot sun in the Riverina district in Australia wants to send the $500 back to the village, and it's costing them $35 or $40 to do that, and it should cost them $1 or $2. So that's another awful tax. That, however, can probably be fixed by the interlinking of domestic fast payment systems. So there's two things going on around the world at the moment. There's projects to develop central bank digital currencies, and there's projects to develop fast payment systems, which, again, the US is only just established now, called FedNow, very recently, but most countries have had them in place for quite a long time. And then the project is to take domestic fast payment systems, like in Australia, where any Australian can transfer money to any other Australian within a few seconds, and link that to international systems. That will accommodate the remittance problem very efficiently. The remittances will be cheap and quick. It doesn't solve the international payments problem, though, because domestic fast payments are limited by amount for AML, CTF reasons, money laundering, terrorism financing reasons. So we still need central bank digital currencies to solve the international payments problem. We don't need them to solve the remittance problem. The remittance problem is a problem we absolutely need to solve. It's an appalling problem, but we can solve it with interlinked domestic fast payment systems. So what are the international implications of these central bank digital currencies being built? There's a couple of, at the moment, we have a global financial system based on the US dollar. The US gets enormous benefits from this. Barry Eichengreen, one of my favorite economists, wrote a wonderful book about 12 years ago entitled Exorbitant Privilege, that goes through and analyzes all of the benefits the US gets in terms of cheaper access to capital, abundant access to international capital, no foreign exchange risk on most US trade transactions, on and on. The US gets lots and lots of benefits from minting the global reserve currency. At the same time, for the last 25, 30 years, the usage of the US dollar has been in decline. So it's still the dominant global reserve currency, but the other significant currencies are being used more often over time. So one potential international implication, if the US develops its digital dollar and releases it for offshore usage, is an increase in the dominance of the US dollar. Making the US dollar really easily usable by making it a central bank digital currency could well see an increase in the centrality of the US dollar in international finance, which would rebound to America's benefit. And one would think America was really wanting to do that, but it's acting in conflict with that often. And the most clear conflict came about when Russia's tanks rolled into the Ukraine a couple of years ago. And the Americans imposed really severe, strong sanctions on Russia. They seized quite a few $100 billion worth of Russian foreign exchange reserves. They could only do that because the reserves were denominated in US dollars. Their jurisdiction to do so isn't inherent. It only flows from the US dollar being the global reserve currency. Russia had been moving into gold, it had been moving out of the dollar for a while, but when it happened, it was still very exposed, and the US was able to impose financial sanctions, which, at least for sort of the first year, caused Russia a fair bit of economic pain. Of course, when America does that, it makes other countries suspicious. And America has done it, of course, before. It did it on Iran, it did it for Afghanistan. Rather egregiously with Afghanistan, it simply seized all of Afghanistan's foreign exchange reserves. The lawyer in me bridles at this. I can understand why America was doing it, but if you approach it as a lawyer, you think, well, that's private property. Why is a sovereign stealing another nation's money? And what about sovereignty? So what about private property? What about sovereignty? The very basis in our legal system. America is riding roughshod over that. But it is paying a big price for it because as other nations have watched the US do this, in other words, watched it weaponize the current international financial system, they're able to weaponize it because the US dollars are at the center of it. As other countries have watched America doing this, they get nervous. They think we don't want to be within the reach of US sanctions. So what is happening is a second block, currency block is developing based around the Chinese renminbi, the ECNY, and Chinese yuan. And the electronic Chinese yuan is working as a digital central bank digital currency within China. It hasn't really been on any substantial scale released for offshore use yet. It's not getting a whole lot of take-up within China because Alipay and WeChat Pay dominate and do things extremely efficiently, world leading, far better than anything else anywhere another country has. But again, according to my thesis, as the ECNY is released for use in international trade, China has great potential to promote that currency in its usage. And it can do lots of things to promote it. And I think it will do lots of things to promote it. Because in this space, China is not concerned about profits. It's not playing a short-term game. It's playing a long-term geopolitical game where it agrees with Barry. I can agree. The US gets an exorbitant privilege out of minting the global reserve currency, and China wants some of that privilege. And China has been working to claim some of that privilege for over 10 years with swap centers on yuan, with denominating international trade contracts in Chinese yuan or in other countries. It's trade contracts with Australia now are quite often denominated in Chinese currency or Australian currency, and with Brazil in Brazilian real or in Chinese currency. China has for quite a long time been working to decrease the usage of the US dollar and increase the usage of its own currency. The digital Chinese currency gives it an enormous potential to do this because it can make it free. It will be more efficient than what we have by a large measure. It will be way cheaper than anything else. And if China really wanted to, it could mandate the use of Chinese currency, right? It could say to another country, if you want to buy our exports, you need to pay us this way. You need to pay us in electronic CNY. And given that it's instantaneous, given that it can be swapped out of, into the local currency immediately, given it will be much cheaper than the alternative and quite possibly free, there is no reason for merchants in other countries conducting imports from China to particularly resist this. They probably should welcome this. So for about 7 or 8 years, I've been saying this is where we should expect China to be heading. We should expect China to be heading to reorient the international financial system. Not that it's dominated by the Chinese currency the way it is by the US currency, but that it's dominated by a basket of international currencies, and the dominance of the US currency is greatly reduced. And that's what we've seen in the 2 years since the invasion of the Ukraine. What we've seen is a second currency bloc developing, focused on the Chinese currency, the rupee from India, and Russia has been trying to promote trade in rubles, payment in rubles, but that really hasn't been happening. It's rather more been, mostly Chinese currency that's being used with a little bit of Indian currency. But a lot of trade between India, China, Russia is now not happening in US dollars. So one potential outcome of a digital US dollar released for international payment would be greater dominance to the US. Another international outcome is a bipolar system with one a currency bloc with the CNY, the rupee, and a few others, and another with, as we have now, largely centered on US dollars. That's bad news, according to the International Monetary Fund, for the efficiency of the global system. It's bad news because the estimates of the IMF, and they're generally pretty good on this stuff, their estimates is a decrease in global GDP of up to 5% if we move away from a system based on the US dollar to a number of competing, one or two or more competing currency bloc systems. And so then everybody ends up poorer because of the inefficiencies in that. So I suppose my message to the US is, I think the US is undervaluing the benefits it gets from the current system. And it needs to think very carefully about weaponizing the dominance of the current system on the current system on the US dollar. Because the US thinks it can exploit that to make itself more secure, by damaging places like Russia economically. But longer term, it's more likely to rebound on America. It's more likely to be that the whole system moves away from the dollar to other currencies. And the longer term effect for the US is less prosperity. And prosperity is central to national security. It's difficult for the US to think in those terms. When you read their security reports, they never mention this. They only talk about the potential of weaponizing the international financial system. They don't seem to be able to jump from one area of international relations to another one of sort of international monetary economics. So there's a siloing effect going on in the thinking. And of course, the immediate is immediate. What's important right now for the America is, resolving the situation in Ukraine. But I do think they need to be thinking long term about this because, as I said earlier, the decline in the US dollar's usage has been in place for a number of decades. Imposing sanctions on other countries is accelerating that decline. And it's not, I think, to America's benefit. It's not legal with respect to the other countries that they're doing it. There's absolutely no legal basis for seizing Russia's foreign exchange reserves. It's merely an act of naked power. And it will probably, in the long run, make all of us poor in all countries, according to the IMF's projections. So that's my message to the US. To the Europeans, my message is stop looking in your backyard so much. The EU rather, is doing a lot of really good work on the digital euro. It's quite advanced. They're doing lots of research. But I think by looking at it domestically, they've got a usage problem. If they look at it internationally, across borders, they will find the real benefits that are on offer. And so there is pushback in the EU at the moment against a digital euro because people are looking in the wrong places for how it might be used. So this is a bit of a perspective from down under, I suppose. In Australia, the Reserve Bank is thinking very much along the lines that I'm thinking, that the real opportunities are international, not domestic. And as I said, Singapore, which is, I think the finest central bank in my region, is thinking exactly the same way. The opportunities are really international, but we seem to be outliers in this debate. So there, my message to the US: think long term in terms of your own self-interest. My message to the EU: think in terms of the benefits that could accrue to international trade, which are really important to Europe, and stop focusing so much on domestic payments, which you do rather well already. On that note, I will end up. Thank you.
I mean, I can also ask a question. I'm interested, I think this is really fascinating kind of on a bigger picture level because of kind of how cryptocurrencies were founded in the first place as kind of a anti-authority, anti-government proposition. So kind of, could you speak more to this tension between the fact that digital currencies are kind of now being co-opted by governments instead, and kind of a larger trend of governments kind of using digital technologies to further establish themselves?
Yeah, I think it is a difficult area. Cryptocurrencies are not currencies, in my view. They're not really used as currencies. They're used as speculative investment ploys and ways of avoiding legitimate. If they're used as currencies, it's to avoid money laundering or terrorism financing obligations. But they're badly named as cryptocurrencies. No regulators, if I'm aware of, call them that. They all call them crypto assets because they function as speculative assets. The demand for a cryptocurrency as a currency is very minute. So again, that's another area where the thinking here gets very, very clouded. With a central bank digital currency, it would focus as a currency. It's denominated in the currency of the nation. It's, the value of the digital euro will be the same as the value of the euro. So it's not a speculative. So they're very, very different things. They're using a little bit of the same technology, but not even much of the same technology. So they're very easy to sort of confuse. But I think long term, cryptocurrencies don't have much. They don't have a use case. They made a lot of people rich. They made some people poor. That's where most of their attraction is. But the idea of cryptocurrency functioning as money is pretty fanciful in my view. The classic definition of money is a unit of account, store of value, means of exchange. Well, a cryptocurrency is not a unit of account because its value varies far too much. It's not a store of value for the same reason. It is a means of exchange, but it's only useful in absolutely instantaneous exchanges before the variability makes it useless. So it only meets one of the three tests for money. So it's really
Perfect. Thank you so much. Any other questions from the room? All right. Well, thank you so much for your time, Professor Buckley. We really appreciate it.
Okay, my pleasure. Thank you. Bye-bye.